Okay.
Hello, welcome to the first episode of our Willow Private Finance podcast. And we're missing one person. We were supposed to have Rob this morning. But so far we've got Steve Pendry and David Habib, who will be introducing themselves shortly. We felt we should release this first episode and hopefully do some regular episodes just so that we can add some colour and content around what on earth's going on in the current market, whether you're a first-time buyer, whether you're a very experienced developer, whether you're somebody who's been in the property market for some time and just want to get an idea as to what on earth is going on with Bank of England base rates, what lenders are doing, and so on. And we felt that it was important that we kind of give some observations in terms of what we're seeing on the ground, with all parties involved, whether they be, as I say, our existing clients or whether it be lenders directly. So with that said, I'm just going to introduce you to the other two that are on this call. So Stephen, do you want to explain who you are and what you do?
Yep, as Lee said, my name is Stephen Pendry. I've been a broker for almost 14 years. I was originally at Mortgage Advice Bureau doing very vanilla cases, as you call them, residential and buy-to-let. The very standard stuff, but now at Willow I advise across the different types of short-term lending, commercial lending, which doesn't mean to say I don't do residential anymore, but yeah, I get involved with a lot of different transactions. So I think doing this, well, we're going to call it a podcast for now until we come up with a name, but I think that I'll bring value to the podcast in that I can give my opinion on why the market's doing what it's doing, what you can do to change what you can do to help your situation. And yeah, I just want to be a source of knowledge, basically.
Good man. And David.
Yeah, hi everyone. My name is David. I've been a mortgage broker for 19 years now. Worked in central London most of my life and have focused on being the senior high net worth mortgage broker and protection broker. I'm here looking at the residential markets more, but again, I've a broad range of experience from over the 19 years, from looking after first-time buyers to high net worth clients, working with high street banks down to include worldwide private banks. I feel that I've got the knowledge and experience to be able to use and advise clients and use this opportunity now to speak about how I am with Willow Private Finance and how we look to progress and give our advice to clients going forward.
Good man. And just to say to anybody watching or listening to this, I'm not a broker and I have no intentions of being a broker. I look after all the operations for the business. So, and I'll be acting as Mr. Naive questions in terms of what's going on in the market, if you like, on behalf of anybody that's watching and listening to this and getting these guys' expertise. So with that said, gentlemen, what do you reckon, what's your thoughts in terms of what's gone on so far this year? And in particular, obviously, we had Bank of England base rates jump up the week before last to 5%. What are you seeing? How's the market responding? How are lenders responding? And what should people be thinking about?
Straight to the elephant in the room, Lee. Is that
100%?
Directly to the point that everyone's thinking about. Okay. Yeah, there's no avoiding it. It's a bit crazy out there at the moment. We thought that we'd seen the worst of it back in October with the now infamous mini budget. We saw basically a taste of what was to come back then. From a broker point of view, it's a very difficult market. I don't know if you'll agree, David, the rates are being pulled pretty much daily. The way that we operate at Willow is that we'll always give advice before we engage. So we'll quote some terms to a client, and then it depends on the speed that they action those terms is when we can send the application. And we have maybe 12 hours to get those terms sent off to the lender and submitted in a full application. There's lots of reasons for it. I think that there's a lot of meddling in the market at the moment from a political standpoint and a monetary policy standpoint. But yeah, David, what are you seeing from the high net worth point of view as well.
Well, across the board, thanks, Stephen. I agree with you and on most of those points. You know, we've been seeing in the market that the base rate has now gone up to 5%, and in turn, we've seen with high inflation rates and high swap rates as watch banks buy rates from each other. But what we're seeing is these rates are pushing up to now 6 to 6.5% on a 2-year fixed rate, and this is not because the affordability is not there for clients that I'm seeing. We're seeing clients are calling me regularly and saying, you know, we're coming off our fixed rates now after 5 years or 2 years being at one point between 1 and 1.5%, and having to go on to 6%. And what we've been doing over the last couple of months is trying to secure these rates, doing product transfers or remortgaging clients. But what's happened in the market over the last 2 weeks has been phenomenal. It's going back to how it was back in 2008, and what we're seeing is how much time and how much pressure mortgage brokers are in at the moment. You know, not just us, but across the whole board. We are given such a short space of time, sometimes less than even 12 hours to get a secure rate for a client, and even so, the rates are changing on a weekly basis. And it's difficult at the moment for us and for clients, and having to explain to clients that sometimes we can't even secure their rates in time because the banks are not supportive enough. I know one of our colleagues was, for example, in a queue with a lender for over 2 or 3 hours just to do an application, which is unheard of.
This is a queue for an application. Yeah. It's incredible.
Absolutely.
Well, and they had, that's a really interesting point, that it's the speed of time the banks are actually communicating, like, okay, we're going to pull a lending product. So, and for those of you that might be watching this that don't necessarily understand how it works, it's obviously, as a mortgage broker, you'll determine the best bank, the best rate, the best product for that particular client. So the assumption by the client, I would imagine, a lot of the time is done, signed all my bits and pieces, is everything else. And we'll get a commitment from the lender to a degree, or we might have an understanding that, yeah, the product's available, yeah, you can absolutely put the client on this. And then literally you could have that conversation on a Monday, and on the Tuesday or the Wednesday, the lender might turn around and say, oh, by the way, by 5 o'clock today, that product no longer exists because we've just scrapped it. And I think a lot of consumers out there don't understand that that's a dynamic in the market. And we saw a lot of that last year, right? There was a huge amount of that happening last year, and that was causing a huge amount of chaos, not just for mortgage brokers, but for all of the specialists that support that as well, right? So you're talking solicitors, conveyancers, all of these people were in a constant state of flux.
It was slightly different last year in that banks pulled their rates because they didn't know what was going to happen. There was so much uncertainty. This time, they know what's happening and they're doing it for a reason, which is, to me, slightly more frightening, to be honest with you. And it's very interesting in that back, I think it was Mortgage Market Review, this came in, where the government asked banks to start being more stringent in affordability. And they told banks that when a client is applying for a residential mortgage, they have to be able to afford that mortgage at 7%. Okay, so the banks were like, okay, how do we get around this? We're going to have to do it. And a lot of us were thinking, why are they putting that such a high rate when rates are at 1.5? And now we're seeing the reason. Okay, but we're in uncharted territory. I don't think that banks really thought that rates were going to get this high this quickly or this soon after MMR. And that's coming back to David, the affordability side of things. Banks don't know what to stress your income at the moment because the guidelines have gone out the window. And luckily for us, we had these relationships with different banks. I mean, I was told by a contact at HSBC 3 days before the rate was being pulled so we could act a bit more quickly. But yeah, the industry as a whole, they don't normally do that. And yeah, it's just you have to be very nimble.
Yeah, and I think it's an important point you make there around stressing incomes. So, and how do they assess that? Because I put a post up on my LinkedIn, I don't know if it was about a couple of weeks ago, because one comment that has been quite common, I would say, since the beginning of last year from people who may have been in the property market for the last 30, 40 years. It's been, well, I remember the days when interest rates went up to whatever, and put your number in, right? But some ludicrous number, okay? But I was looking at something else along that. Someone else put a post up and did a comparable between incomes, property values, and the average cost of the mortgage versus as a percentage of income versus what happens today. And they did the calculation, and I think the stat was, I'm remembering this off the top of my head, but it's I think the stats was something like a mortgage in 1981 represented something like 11% of your income as a cost, and now you're well over 50, if not 60%, in terms of the actual cost of the mortgage and what it takes up. And so when we're talking about rates at 5%, 6%, and so on, that you can't say, well, they went to 10, 11, 12, 13, whatever in the past, so we should be fine. It's an entirely different animal today. And so you can see why there's this state of flux with the lenders in assessing their client base, right? Because they don't have any reference point for this.
There's massive knock-on effects to it as well, because once interest rates start to rise, obviously, I mean, we'll come back to this, but I think it's a very blunt instrument at the moment, with a lot of people being in fixed rates, but we'll address that separately. But the knock-on effect is that people are spooked. They don't want to buy houses. House builders don't build houses because they know that they can't sell them to people that are looking, because it's basically a buyer's market at the moment. There's just not enough buyers around. And I was reading a stat a few days ago, and I know that private landlords have got quite a bad rap in recent years and being blamed for the reason why house prices are rising and why first-time buyers can't get on the ladder. And the government has brought out policies to try and make it less attractive to be a landlord. But if you have a look at the figures, 70% of the houses in the UK are owner-occupied. 30% of houses in the UK are owner-occupied without a mortgage, 40% with a mortgage, 18% is social housing, and 11% is owned by private landlords on a private rental basis. Now, it is a significant figure, but not significant enough to influence the way house prices are going. So I did a little bit of more digging into why it's happened. And the stat that was absolutely crazy to me, and I don't understand why it hasn't been addressed, and it's something that I think a lot of builders need to get behind, is that since 1990, on average, there's been 121,000 homes built in the UK per year. During that time, on average, the population has increased by 250,000 per year.
Oh, wow.
So is it not obvious that the problem is the supply of housing causing these house prices to rise incredibly?
Mm-hmm.
Like, I mean, we see it all the time, David, right? You get a builder that has a scheme that has maybe 50 houses, right? And they've got the skills to do it. The lender's willing to lend, but they don't have enough money to start it off. And there's no government schemes to help them do that. The skills are there in the economy, but they're just not able to do it. Sorry, I'm diverting a little bit. It was just something I read that was
that's nuts.
It's really
sent an alarm off in my brain.
Yeah, no, I agree with you again. Some good stats there. That we've had a shortage of housing for many years, and yes, the house prices have continuously grown and gone up to a point now where, you know, with everything that's happening in the market, we are heading into a crash. What I've been seeing in the last couple of weeks now is down valuations happening a lot because of the market conditions, or because people are so nervous as to whether it's the right time to buy, whether it's the valuers themselves, the surveyors. I was having a conversation with a surveyor yesterday, and he was saying right now, I was looking on the buy-to-let market, working on a case at the moment for a developer looking to convert a standard house into a 6-bed HMO. And picked up the phone to a surveyor to discuss how he's going to potentially value this property and where they are in the market. And they feel very nervous as to where they feel that the right price should be for properties, and bringing properties on the market, what they're going to come down. Property are going to basically, they're going to feel that the house prices are going to come down. They're going to down value properties because they need to consider where the market conditions are and where we're going to be in the next year. And it's nervous for a lot of people who are holding back now.
Do you think though? Yeah, I mean, sorry to cross talk, but do you think that this is a bit of a perfect storm though? In that we've got house prices that are very high. We've got interest rates that have climbed higher than most people, because most people have got a really short-term memory, right? And a lot of people that are coming in who have been on the property ladder, I don't know how the percentages worked in terms of age range per population, per length of time they've had a mortgage and the likes, but it's reasonable to think that, okay, over the last 13 years, there's a huge chunk of people that have come on in the last 13 years that have taken on mortgages that have never experienced higher rates or experienced anything other than a seller's market. And so are we seeing a bit of a dynamic in that regard in terms of this mix of, yeah, there's more competition around or more negotiation happening around house pricing, which most people haven't got any recent memory of, because the assumption was, the asset's just going to, you buy it today, it'll be worth X amount more in 6 months' time. So just buy it, pay for the asking price. Because I remember when I was a kid, the negotiations my parents used to have about buying property. And I remember my father was always a really aggressive person when he used to put in his offers. And it was assumed that you would get a discount on the purchase. And it was just about, well, how big is that percentage discount going to actually be? And I don't think we've had that for at least a decade. And so the idea of a collapse, I prefer a concept of maybe correction and adjustment, in that if you think we're 15, I saw a stat the other day that said that property prices are still 15% higher than they were pre-pandemic. So if we lose, let's say we have a 5% shrinkage this year, which is being tipped as a real possibility, right? That's still an enormous amount of growth in a 24-month period, 36-month period, or whatever. And I think that's why this podcast is so good, right? Because I'm an over optimistic person. So it's good to have maybe a balance in this, but that's I think maybe it's not a crash, but rather the correction and an adjustment into a different type of market, which is probably more akin to something that was happening in the 90s and before.
Well, interesting you say that. I mean, if you go back to 2004, when I started as a mortgage broker, the average base rate, the Bank of England base rate was at 4.5%. So, first-time buyers were buying at 100% mortgages at that rate. That was the norm. What we've seen.
My first mortgage when I was in my 20s was at 7% I think at one point. And it wasn't 100% mortgage, but I remember getting it around the 6-7% marks.
But then it was a mortgage broker, Lee.
I know.
Quite a high rate, but no, I understand what you mean, but it's very, very high at that time. There were rates. You might remember the day you probably gone to someone like Northern Rock, who were pricing roughly at 6.5-7% on 125% mortgages. Back in 2004, and obviously we had the crash, and then going back to what we've seen in the last few years is unprecedented low rates. We've got the base rate that's gone right down. We've got banks pricing 5-year fixed rates at 0.99%, on the high street, and coming out of that now to where base rate, the clients who have bought properties maybe for the first time or second time, and you have got this used to the lower rates out there. They're now coming off those fixed rates, and that's going back to what we were talking about in the beginning, is they're the ones that we all are worried about. Where is this going to go? How much can I afford, especially in the London market as well? Being a London broker, people have geared up their mortgages so high because of the low rates of mortgages. What's going to happen in the next year? The government solutions that they've announced, the government mortgage charter, states that they'll give you interest only. You can switch over to interest only for 6 months. We won't repossess for 12 months, just to help out clients. But that's not a solution in my eyes.
But there is an argument to say that, so one of the things I think you guys have seen, we've all seen as a firm, is since that mini budget back in, I think it was late September, and that created this weird dynamic in the lending market in terms of lenders were becoming very competitive and very aggressively so. So we were seeing, say, towards the latter part of last year, we were seeing some innovations happening in the lending space. And in fact, when the press was talking about, lenders are doing this and they're acting really negatively, one of the things that we as a team would talk about on a weekly basis was, actually, no, we're seeing rates coming down by lenders. We're seeing them being far more dynamic around their approach. And one of these things is,
sorry to cross, there's always a delay with the media, and that's the problem. It's always a 3-month delay. We see the tide turning because we're on the front line, but people are still scared for another 3 months, and they don't take advantage of that tide turning. No. Which is why,
again, going back to David's comment about you should have a mortgage broker. it's true, right?
Well,
but again, the reason why I point that out is this a solution not for governments but for lenders? Lenders are going to be sat there, right? They know what's on the horizon. They're going to be sat around the table trying to create solutions that enable them to capture and deploy, catch clients and deploy as much funds as possible. So, I mean, Skipton, for example, just recently did the 100% mortgages again, which everybody was very shocked by, right? I think everybody was kind of thinking that we wouldn't see the return of that. Do you guys see more innovation happening in the lending market that might help ease some of these concerns? Because I think governments as a whole are probably not the best resource to create some of these solutions a lot of the time.
It's very difficult for lenders to do it because there's so much red tape. First of all, they have that 7% stress rate imposed on them. Their whole mortgage book can't be more than 5 times income in most cases. So that's why we have this general rule of affordability of 5 times income. The good thing is that some lenders for very high income earners will say 5.5 because some of their book is sitting at 4.5, so they can balance it out a little bit.
Right.
So it's very difficult for a lender to lend more money based on those two constraints. It's Skipton, it is big talk in the industry about Skipton, how they've managed to do that, but it's a welcome innovation, like you say. It's very welcome because renters have been stuck for so many years. And before I move on, I'll come back to your point about the negotiation of house prices, right? I came into the industry just after the financial crash around 2009, 2010, when all these measures came in. So I've never known any different, really. I've never known the good old days, as David would call them, before the financial crash. And when I speak to first-time buyers now, they don't even know that they can negotiate on a house price. Like they'll come to me and they'll say, right, I'm going to put my offer in for 250,000. And okay, have you been to see it? Yeah, we've been to see it. We really like it. Did you tell the estate agent that? Yeah. I told them we really like it and we're going to buy it. And it's the naivety that's causing the estate agent to have quite a lot of power over the transaction because it's made emotional. So it comes back to this whole idea of psychology, and psychology powers what's happening in the economy now. If people view that inflation is still going to be high in a year's time, they'll buy everything now, creating more demand now and therefore more inflation now. If they perceive inflation to be in a better space in a year's time, then they have less demand now, and that's what the Bank of England is hoping. So it's all based on how people think. And this is why you go to experts for so many different things. You go to an expert if you have an illness, for example, you go to an expert to see what's going on. Not many people approach a finance expert, or people that don't should. It's very intuitive to me that you'd ask an expert on these things. And I will guide first-time buyers. I will say, okay, let's have a conversation about this house. I know your mum and dad have probably had a chat, but the last time they bought a house was 45 years ago. The market has changed. So let's have a chat about what you should offer. I'll tell you an amount that's not cheeky enough for them to tell you to go away, and I'll also tell you a figure that you're probably going to get, but you'll have to negotiate on. And it's a very British psychology to not negotiate.
Mm-hmm.
So all these different factors lead people to becoming almost ripped off when they're buying houses. And that's the way it's been for so long. But now we have this buyer's market where people need to start taking advantage of all these factors.
Do either of you have any thoughts
difficult.
about? Would you have any thoughts about the talk of inflation and all of this? Is there any considerations that you've got around that? I mean, I know we're not economists at the end of the day, but I think it's an interesting dynamic.
I wanted to come back to the point of interest rates being a very blunt instrument now to control inflation. I mean, it was a while ago that I read this, but the vast majority of mortgages are on fixed rates now. There's 11 million mortgage holders in the UK, and 1 million of those are coming off a fixed rate towards the end of the year. Okay, so when interest rates were used to control monetary policy before, a lot of people were on tracker rates, and therefore it was immediately evident what happened to those mortgages. Like they immediately fell or they immediately rose, and they can control demand in the economy quite between very tight parameters. But now we're putting rates up and people are only thinking that they're going to have to pay a higher amount in the future, which is a very different psychology to what it would be if next month your rate's going up, so you start cutting back, right? Yeah. So are we going to drop off a cliff in January once 10% of those mortgages move off fixed rate?
Yeah. Well, we've seen instances, right, where clients have not necessarily been watching very closely what's going on, and then they're faced with, we're not talking tens of pounds or hundreds of pounds in some instances, are we? We're talking, David, you alluded to earlier to how heavily geared some of these properties are, right? So that these clients have. We could be talking thousands of pounds of increases in their monthly commitment, not annual, their monthly commitment. And rates of wages have not grown substantially in recent years. So it's you do wonder, okay, well, what are the options for these individuals when they're faced with that? So sorry, David, you were gonna.
Yeah, I was just going to comment on that before you move on. As an example, I've seen an average mortgage in London, I'm going to say is around £400,000 on a standard property of around £1 million, or just under even. Typically, I was looking at a client the other day to give you an idea. They were on a fixed rate that came off at 2.6%, paying on interest only. Took a interest only mortgage, for example, over 25 years with the intention to pay off through bonuses or overpay and make overpayments. And they took this like 5 years ago. Looking at the client's criteria now, they've come off this mortgage and they've got 20 years left. They're on interest only. And the rate's gone from 2.59, to 4.7 we were able to secure for them, not considering what would have happened if we went today at 6.5% on a 2-year deal. The monthly payments on that for this person went from £650 to £1,598. That's almost £1,000 extra a month on interest only. Just to give an example, on a mortgage of 400,000, going from 2.5 to 4.7. And that's what typically many clients are going to be being affected by. And that's the concern of, and if it was at 6%, it's a huge amount. And it's so important now to use a mortgage broker to advise and search through the market, being a whole of market lender to broker, to be able to look at all the lenders out there, because there are specialist lenders out there. There are high street lenders out there that we can potentially try and, spread the costs over a longer period of time if you're on capital repayment. But if you're on interest only, it's going to be very difficult to and the payments are going to be a struggle for many people.
You make a very valid point in there, David, in that act early or as quickly as you can, because mortgage offers usually are valid for 6 months. You can secure a rate today. If rates go down, you can move on to that lower rate. And this is the value of a broker. They can monitor the market as you're approaching the end of your deal. If rates go up, you've got that rate secured. So it's a win-win situation where you act early. And the other thing is, if your mortgage is ending in a year, because I can't see rates coming down significantly in a year, in that, speak to a mortgage broker and set up your payment to be higher, so that you're used to that payment. Not only are you used to that payment when you come to remortgage and move on to a higher rate, but you paid off more of your mortgage, and therefore the impact is less than what it would have been if you'd just been paying the payment that you agreed to at the beginning of your fixed rate this time. So there's those two factors that I'd really say to people: have a word with your lender, or have a word with a mortgage broker. Just say, look, what do I need to pay, or what is it going to be in a year, so I can set it up now and start getting used to it, start adjusting myself, start paying off more of my mortgage. Because if you're sitting on a 1.5%, between 1.5 and 2% rate at the moment, and you up your mortgage payment by £1,000, for example, that £1,000 is coming directly off the capital you owe. So that's just a snowball effect. As you pay off more, it's less interest, and therefore more of your money gets paid into the mortgage. It just keeps snowballing. There's a stat, isn't there, David, that if you add something like, if you've got a 30-year mortgage and add £50 a month to it, it cuts 3 years off the mortgage, or something crazy like
Jesus.
that. Yeah.
Oh, wow.
Depending on the size of the mortgage, obviously, but yeah.
Yeah, very good point, Stephen. It's very important. If you can afford to make any overpayments, it will help, even if it's by the smallest amount, just to help you for over the next 2 years. Some clients are going to be able to do that. Some clients aren't, obviously, but we can certainly advise our clients and anyone that approaches us to be able to structure their loan and help them figure out what is the best option to move forward in the next 2 years at least. I do feel personally that I've been advising clients to take a 2-year fixed rate rather than a 5-year fixed rate, with the intention that hopefully inflation does come down within the next 2 years, or is under some control. I
want to address as well the other baby elephant in the room with its hand in the air, and that's private landlords. Like, they have had a bad rap. Like, there's no getting away from that. But the implications of rising rates, I mean, they know better than most that rising rates are a problem for them, and they generally tend to act quickly. But I wanted to go over the impact of rising rates for landlords, because not many people understand the stress rates that are applied by mortgage lenders, either over a 2-year period or a 5-year period. Most landlords within the last 3 years that have remortgaged will understand that if they're a high rate taxpayer, a 2-year deal just doesn't get you enough lending already. And now we're starting to see it with 5-year deals.
Term, sorry to cut across you, but for those that are watching this or listening to this, can you just explain what you mean by stress rates? What are you talking about there, so that people can understand how that's looked upon?
So most people know that it doesn't really matter what you earn as a landlord, only in that whether you're a higher rate or a lower rate taxpayer, or if you have it in a limited, if you hold the property in a limited company. A stress rate means the interest rate applied to the lending by the lender, so that you can afford the mortgage payments if rates rise to a certain amount. So, for example, historically, a 5-year rate would be stressed at 5% and a pay rate of 125. So if you had a £100,000 mortgage, they'd stress at 5% and then add 25% on top, because they know that 20% of that rental income is going directly to HMRC. So you need to be able to afford that mortgage after your payment to HMRC, after your tax is paid. And it's even worse for higher rate taxpayers, in that they want to make sure that you can afford that mortgage at 5% at 145%. But now, if you think we have rates sitting at 6.5% for a residential mortgage at a 2-year fixed, for a buy-to-let, they're even higher. So most banks are now stressing at maybe 8.5%, which is 3% more than what it was a year ago even. which means that on a £100,000 mortgage on a rental property, that increases the amount of rent that you need to obtain for that property to get the same amount of lending by about £600 a month. So if you have a £200,000 property that maybe pulls in, I don't know, maybe just for instance, £1,000 a month, you've now got to put your rental up to £1,600 per month to obtain the same amount of lending on a 2-year fixed if you have a £100,000 mortgage, which is, it's just not going to happen. And this is why I say landlords have a bad rap, because effectively the only option is to either reduce the amount that you owe or sell the property, or stay with your current lender that is probably going to charge you above market rate because they know that you can't move to another lender. So you're stuck. And this is why, David, I don't know about you, but I have not done a buy-to-let purchase that's ready to rent. So we've done obviously properties that can be renovated because there's still money in there as equity that you can use for the lending. But a buy-to-let that's ready to rent, I have not done a purchase for maybe 9 months. I don't know.
Agreed, Stephen, yeah.
HMO purchases happen, but yeah.
Yeah, no, totally agree with you there. Buy-to-let landlords have had the bad rap on this. I haven't done any buy-to-let purchases. Definitely some HMO remortgages because the rental stress fits, and it is that we are seeing now so many more buy-to-let properties coming on the market because landlords are not able to. The rent does not cover the stress tests that are available to them at the moment, and even some of it doesn't, with the taxable implications that are available, and the government took away years ago, where not being able to offset your interest payments, the mortgage interest payments. Some buy-to-lets, if you haven't got a portfolio and you've got 1 or 2 buy-to-lets, it's not worth it right now to keep them the majority of the time. It's so difficult to be able to. Is there looking at the future, what's going to happen with these buy-to-lets? The rental figures don't cover the mortgage payments, so they have to sell. And unfortunately, this is what's happening, and we are seeing more and more buy-to-let properties come on the market.
Well, you're also seeing a narrative in certain areas of mainstream which are painting landlords in a very dark way, right? I saw something on LinkedIn yesterday which was going as far as calling landlords parasites and the likes, and you think, good Lord, the fact that that's entering into mainstream narrative around those positions and so on is just horrendous, because it's a very one-sided picture in terms of people who are renting are having the most pain. But fundamentally, a lot of these guys that are landlords aren't necessarily all big players. They're often individuals who decided they wanted to create some wealth for their children, for their family members, out of probably an asset that they've owned. I mean, you named reference somebody that owned their property for the last 45 years. So, okay, we want to release some equity in that and maybe build something for my children in the future and everything else. There's a very human aspect to that, where there's a big community of people that are in a lot of pain in that space, who obviously also feel an obligation to their tenants as well, and they're stuck between this rock and a hard place. One of the things
just before you move on, Lee, another thing is that they're now expected to make all those properties that they bought up to an energy efficient rating of C. So they're helping the housing stock in the UK become more energy efficient as well.
Yeah.
So
and is that by 2030?
Lenders are trying to help.
When is that by?
By 2030. Yeah. But you've already, I think maybe they pushed the deadline back now, but the deadline was April 23 to get it up to a D level. But maybe they pushed that back. I haven't looked into the legislation recently. But yeah, it's incredible. I mean, I personally, the problem is that British people have been told since they could understand that property is the best thing to get into by their mum and dad. So the clever amongst us have gone, okay, so what's better than 1 property? 2. And they've gone and bought another property and benefited from it increasing in value. But coming back to my point at the beginning of the podcast, there's only effectively 11% of the housing stock is owned by private landlords. And the fact that the government are trying to get I effectively think that they're trying to get landlords to sell so that first-time buyers can get on the ladder, which I agree with because I'll be a first-time buyer myself this year. But it's a short-term solution to the price of housing, right? So maybe in the short term, there's more stock about, but we come back to the point that for every house that's being built, there's 2 people being born every year. And it doesn't make sense that we're going to make landlords the scapegoat. Mm-hmm. Sorry, I'm sticking up for landlords today. It's well, they don't normally get it, so they deserve it.
Well, I think it's a mistake. I think the media likes to always have a bad guy, right? They always like to and depending on whatever the political agenda is at the time, they'll just create this bad guy, and I think it's important that we always take kind of a balanced approach in that, because there's pain across the board, right? Going back to some of the comments that you both made around the right advice through the journey, it's not simply, in my view, it's not simply about access, right? So you guys talk about access to different lenders and being able to move quickly and everything else, but if you look at just the 2 of you on this call, the combined years of experience that you have in this space, that you've been exposed to a lot of strategies by different individuals that you've worked with, right? And as you do every day, whether they be landlords, property developers, or just generally people that are just looking to buy a home. And those strategies you can share effectively with your own client base. And I think that's something that's underestimated when people bring in a specialist of any form. They're not just a specialist in terms of access, they're a specialist in terms of, we've got these set of strategies that we're seeing played out in real time that are either winning or losing. And that's something that's not spoken about enough, I think, because you guys, as Stephen's shown, have a quite finger on the pulse in terms of what's going on in the market. And you can watch in real time who's navigating that successfully and who's failing. So, and that's why specialists, in my mind, are so important to any consumer.
Well, I mean, we've had to get extremely creative this year, haven't we? We've had to go outside of the UK to banks in India, to banks in Nigeria to get lending, because they're regulated, but they don't have the stringent controls, and it means that they take a view on the income that you receive from a buy-to-let. Like, for example, there's a bank in India that will lend an amount of money that no bank will in the UK, considering the rental income that you get, and they'll keep a proportion of money in a savings account for you in case you can't meet those payments. So it's a very pragmatic approach to an increasing problem. I mean, they do charge a higher rate, but if you need the money for other projects, then it's worth doing. Like that you just have to.
But that could be a bit alien to people in the UK, right? Because growing up in the UK, you get very accustomed to a small number of the main banks. And you kind of grow up with this. I mean, I remember my dad with his Lloyd's checkbook. You know, it was a big thing to have the black horse on the, and they're your main bank you go to or whatever it is. And like in places like America, for example, there's thousands of banks and so on. But in the UK, we kind of grow up with this philosophy of there's only a handful of banks in the country that you should use. And I think when they meet people like yourselves, it's that, and you understand that actually you can get lending from anywhere on the planet effectively, and it is held to the same UK standards in terms of from a regulatory obligation. I think that's alien to a lot of people in the UK, right?
Yeah, well, it's the challenger bank market, right, David? For
absolutely right.
Different types of lending.
We've got the challenger banks, we've got the specialist lenders, part of the challenger banks that have grown over the last 10 years to be able to fit this niche. That fortunately, thank God they're there, to be honest. If they weren't there, like you say, back for your parents and the mainstream banks, if we didn't have the growth of our building societies, smaller building societies, manual underwriting, challenger banks coming in, giving better stress tests, maybe charging higher fees, but allowing the investor to be able to purchase, or even a first-time buyer, being able to give them a little bit more than they would normally get from a standard lender. There's one lender giving up to 6 times income at the moment for first-time buyers, which is, you know, unheard of really, but the rates are going to be pretty high. And you know, on the high net worth arena, you know, we've seen how many different lenders have come into the market, not only your private banks, but other lenders, even the high street and some other specialist lenders building up their lending amount, you know, knowing that they can lend a little bit more, over 3 million, you know, which was kind of like the norm, 1 to 3 million, or 3 million going upwards for a private bank. But private banks are coming down to 1 million, and other banks are going up to 10 million, 15 million. So it's opened a door to like different lenders being able to structure things in different ways, and use for high net worth clients, like using their investment portfolios and putting assets under management, using not diversing a little bit here, but basically talking about what does a high net worth individual have that can offset against these high interest rates. Do they have investment portfolios where they can lend against the portfolio of wealth management, rather than actual take a loan on the mortgage at a rate of, even the private banks are pricing their rate at SONIA, which is similar to the 3-month LIBOR rates. And that is still priced at 6% or over. Looked at Coutts's rates went up last week. They're a private bank, but you know, again, 6.5–7%. Which is completely unheard of from a private banking point of view. So it's affecting everyone across the board, and lenders are having to make changes, and we're trying to find solutions for clients, where whether they're looking to buy, like foreign national clients, the London central market, from what I was reading this morning, you know, hasn't been hit that much, to be honest, in the effects of like prices haven't come down. And we've seen that over the years, is they quite stay stable, while the rest of the UK is, and the rest of London even, is coming down slightly, but central London is still within its little bubble. But the problem is the rates are higher. Foreign investment, we had huge influx of foreign investors over the years coming and looking at and taking over the stock, and not having enough in the UK for, you know, the UK citizens to purchase, you know. But they were the ones with the monies. The rates were low. They were getting a better investment on their money. Now it's a completely different turn for them as well. We're now looking at what other sources of funding can we obtain for them? What other strategies can we use, or private banks to use, to be able to provide funding, such as Lombard lending, which is lending against their assets, their portfolio, wealth management portfolio, which is another way of them getting a lower rate of about 1 to 2%, rather than a 6% mortgage, which is huge, absolutely. And that's where I was speaking to a Qatari client this week, and he was saying, you know, is it the right time for me to buy right now? What's happening in the market? Well, first of all, prices will come down. You know, you can negotiate more, even though, say, central London is within its bubble. You know, we need the prices. You know, I'm seeing up to 10% of reductions on some properties at the moment, and clients are a bit more savvy. I had another Australian client looking at a property, buying, looking to offered on a property at around 2 million on a Muse house that needed work, rather than him buying at 3 million that he could have, that was all done. You know, he pulled out that one, said, I may as well buy something at 2 million and see what I can do with some kind of investment, and using more cash, and looking to refinance at a later date, or trying to, you know, look at what options are, to strategize their portfolio and increase their ability to buy in the UK. So we're seeing a different strategies from different banks, and different clients take a different view on it at the moment.
Well, I think we see a lot of, sorry, so just to say that I think by the nature of Willow Private Finance, because we're a specialist brokerage, we invariably tend to attract a section of our client base tends to sit in this high net worth, ultra high net worth space, right? And they have, because they often have complex needs, right? And complex sources of incomes, could be complex residential statuses, all sorts, right? So there needs to be this more strategic approach. But what I would say is they're probably more used to this global approach to financing than the average Joe in the UK. And I think this, and I think that's news to a lot of people now, as specialist requirements grow for the average Joe, because of the way the property market's moving. they've got to open their mind to the fact that, no, you don't have to go to these mainstream banks. You don't have to do all of this stuff. Whereas when we speak to our ultra high net worth and high net worth individuals, it's like, well, of course, I've been doing that for my whole adult life. I wouldn't expect anything different. You know, it's a very different paradigm between those two groups of individuals, I'd say.
The thing is, it's not, if I'm right there, it's not up for them to determine whether they cannot. It's us. It's just a conversation, right? We have a conversation with you, and we will tell you if there is other funding lines available to you. It's very simple. 15-minute conversation.
Absolutely right. Exactly that. Is, so, you know, we are the ones that have to tell them, advise them now, because, you know, they feel that, oh, why can't I just get a loan? You know, why is it, you know, I've got the money here, I want a mortgage, or I'll buy it cash, you know. They're very savvy, but also the ones that do need a loan or do want a loan, you know, it's again because of the way that the stress tests are. If it's a buy to let, foreign investors buying, we had these specialist lenders, we had these challenger banks that you would deal with foreign nationals, can lend to foreign nationals, and looking at how they were so popular a year ago, even, you know, and before, you'd have several different banks pricing as a normal buy to let for foreign clients, buying, you know, at 5% on for a foreign national to purchase a property through the challenger banks, not having to go through private banking that may need assets under management or not. But we are seeing now that giving advice is so more important, even to the high net worth client, as well as everyone else within the UK. And it doesn't matter what level you're buying at. If you're buying in the UK right now, it's not as easy as it was over a year ago. So our expertise is coming in to be able to say, well, look, you know, it doesn't fit with a private bank, but I have a challenger bank it will fit with, because of the structure, you know. And those challenger banks, whether you're an expat in Dubai or, you know, a foreign national in Qatar or Australia or America, you know, we can look at certain other lenders apart from private banks that will give you a certain level of funding that you wouldn't have been able to get, or not able to get, through your standard high street, your standard private bank, purely because of restrictions that they have on that at the moment, and the rates that are coming out with them as well.
I mean, the role of challenger banks is another episode completely, right? Like we could talk a long time about that. But one key observation that even anyone listening to this podcast can see is that, look at the archaic high street banks, Santander, like the big names. They don't do limited company buy-to-lets. And most of the time, well, I mean, if everyone's circumstances are different, but most of the time, to get max lending, or the most tax efficient way, is to hold a property in a limited company for most people. And our old banking system, coming back to the other point about having to go to these challenger banks that maybe people are not comfortable with or never heard of, they're regulated just the same. People just don't know that they exist. And that's why we come in and provide that lending for them.
And mentioning about going on what you said about the stress tests before, you know, the challenger bank lending to a limited company, the stress test will be for a limited company at 125%, which is what we need. Where, you know, it's just giving the right advice, and whether they're purchasing a property, to purchase it in a limited company rather than a personal name. But then obviously taking tax advice, which is another area that we can advise and refer our clients to, because we have some very good tax specialists.
It's the first question we ask, right? If you're buying a buy-to-let, how are you going to hold it? Have you had structured tax advice? I mean, I probably had 10% of my clients say, yes, I've spoken to my accountant and this is the way I want to do it. So it's an underserved market, and you don't know until you're told. And that's our role, effectively.
Yeah, it's that we say it a lot at the moment, and it's this holistic approach to looking after people in their property journey, because these are no small things, right? These are life-changing transactions, and for it, whether you're making an investment or if it's somewhere you're living in, and you do need a individual that's going to take responsibility to guide you through and navigate through that maze of making sure that you don't, because some of the pains that these individuals put into play, they may not realize for years after the fact. Tax is a great example of that, right? And in particular, things like inheritance tax planning and the likes as well. I mean, how many times do we see those discussions? And I don't think it's probably right for this particular episode, but I think in future episodes, talking about things like property investment, property development, and so on, and the challenges that these guys are facing in the current market as well, will be one we should definitely cover. Because obviously they're seeing a whole host of issues today around what they do with their developments and the likes. And again, it's having the right advice from the very, very start, as early as possible with these projects.
What do you think? If you open up an SPV, a special purpose vehicle, to hold a property, you don't have to pay tax on that for 18 months. So you're not even going to know you've set it up the wrong way for 18 months anyway. So yeah, right from the very beginning, even before you buy the property, advice every step of the way.
Good. I think that's a good place to end our very first podcast. So thanks, gentlemen.
On taxation. Thank you very much.
Go out with a bang.
At least we left it till the end.